Okay, everyone, welcome back to Pete's Investing. Today we're going to be talking about stop losses and see if there's any value in using them. So before I give you a clear-cut answer on that one now, let's just go through some preliminaries. First of all, just review the channel playlists, to review the indices, the share prices and our strategies. And that's where we keep all our strategy videos to get a better understanding into how to invest and trade safely. We're not offering financial advice, it's purely an educational video series. Now, the following thing I'm going to show you in terms of averaging down versus stop losses applies to any instrument, whether it's FOREX, shares, indices, and it also applies to any time frame when you're doing this, but we also need to do some back testing, and we'll cover that in a few minutes. First of all, what is a stop loss? A stop loss is an order in place with a broker to buy or sell a specific stock once the stock reaches a certain price. A stop loss is designed to limit an investor's loss on a security position. So a simple stop loss example, let's look at the highs, lows, swing high, swing low process, if you want to use that approach. So as the price reaches new highs and new lows, so you would typically, when it breaks a new high, you may want to enter a trade there. Again, this is just an example. We're not suggesting you use this technique. And you may want to put a stop loss at this major low down here and this swing low here. Or you could put a stop loss at that swing low there, or even a stop loss at that swing low there. As the price keeps going up, and then let's say it reaches up here, you raise your stop loss and you bring it up to there so you can minimize your or maximize your gains. So as the price keeps going up, you put another stop loss there, and probably another one there. And you would have probably been stopped out at that point there. So you would have had a nice little gain. Now that assumes the price goes in your favor. Another example up here, you would have probably if that was a new swing high, swing low, you would have probably entered it up there at the very peak, and you would have had your stop loss down there somewhere. This, by the way, is the COVID period during March 2020, and we're going to use that in our charting examples to deliberately show you how to test against downswings. So when a stop losses are beneficial, if you're speculating, gambling on a stop price or instrument to go long, but the price goes against you, that's when you use a stop loss. Or if you're speculating or gambling on a price to instrument to go down, short, but the price goes against you, that is, the price goes up. Why stop losses generally don't always work? Well, they do work sometimes, but you've got to be knowledgeable in terms of where you place a stop loss, which strategy will you use, which indicators, if any, will you use, and what win-loss ratio will you adopt. So again, I hope it's not too heavy for you, but we're just trying to give you an example of stop losses versus the average down approach. So in terms of entering in this example, in this strategy we're going to say if the CCI 100 breaks above zero, we're going to enter the trade. And the same applies for both stop loss examples and the average down process. We're going to close a position with a profit with a 2 to 1 ratio. So if it gains 10% from the purchase price, we're going to close out the position. That applies to the average down process as well. We're going to stop loss in this example if it goes 55% loss. Whereas if it goes down 5% in this average down process and the CCI breaks above zero, we're going to add another position to our position. So when it finally does break above the average price with a 10% gain, we're going to close out the position. So in other words, we're not using a stop loss in this example. We're averaging down whenever it reaches this entry criteria. And I'll explain that in the chart as we move forward. So back testing and comparing average down versus stop losses, or the drawdown effect. And the drawdown is basically from your highest profitability level to your lowest profitability of the chart. So there's minimal drawdown on the drawdown effect, and there's a greater drawdown effect on the average down process. So that's a negative, and that's a plus. Profitability, there's minimal profitability over a longer term, and there's a greater profitability over the longer term for the average down. The back testing, we want to back test the win-loss ratios in the worst case scenario. Remember what I told you about the COVID epidemic during the March 2020 period? We want to make sure we test it against those sort of scenarios. So we test it with the worst case scenario and see how that works with our stop loss versus the average down process. And I'll show you that in the chart in a few minutes. If you can be patient, please. So back testing timeframes. Normally shorter time frame, the price goes against you and you're stopped out. So it's a shorter time frame impact there. And over the longer time frame, when price goes against you, you have to sort of have deep enough pockets to average down and stay mentally alert and keep going with this strategy. The trading account impact. Well, there's less impact on your position if you stopped out early, and there's greater impact on your accounts if you're in it for the long term. So again, you need to have nerves of steel and good money management rules with your average down process. So here again, we're using our very simple trading example. If we're entering where the CCI 100 breaks above zero on both examples, we're stopping it out when the close drops by 5%. With the stop example, and we're exiting with a profit when the close breaks above 10% gain, and the MA20 turns into a downturn. This strategy, we're using the same entry and exit criteria, except instead of stopping out at 5% drop, where when it reaches a 5% drop, we're waiting for that CCI 100 to break above zero again. We enter another position and we average down. So that's the difference between the average down approach in this example versus the stop. And again, there's various examples of your strategy, so we're just using this very simple example to show the comparisons. So again, very simply, we exit when there's a 10% gain, and we average down with a 5% drop, or we stop out in this particular strategy with a 5% drop. So what does that look like? Let's stop with the messing around and the theory. Let's get to some really serious examples. Again, this is the charting software I'm using. This top chart is a profitability chart, and that shows you how much profit you've made. Now, this is a baseline of 100,000 for each of these. This is the stop loss profitability, and this is the average down profitability. So you can see here, we're trading on a 2-hour time frame here, and this goes back to the end of 2018, start of 2019, and you can see there the impact. This is a price chart. You can see the impact over the early 2020 period when COVID hit. Now here I'm trading on the ASX 200, and I'm buying one contract. So this top chart shows, you can see here these little bars that indicate, at the start of those bars indicates where we enter the position. So each of these entry, and when it closes the bar, it closes out the position. So you can see here, while the price is going up, the stop loss strategy was working quite nicely. A couple of little losses, but it was working quite nicely overall as the price chart goes up as well. But as soon as you get a little bit of a downturn, like in this example here, that's when you start losing profitability. You can see here the price dropped quite significantly there, because obviously there was the 5% drop wasn't low enough in terms of stop loss. So you probably could have put in a 10% loss, but then you would have had more greater losses overall. And again, the price chart started turning down there during that August-September period, and the stop loss strategy started losing money there as well. So you're actually breaking even at the moment with a $100,000 baseline. Whereas the average down process, you can see here, each of those bars enters a position there and it closes out a position, enters a position and closes out a position. So you can see that in that little example, we entered and exited very similar profitability. Let me just drill down on a couple of these. So again, entered on the stop loss example and exited with a loss. Entered, exited with a loss. Entered, spiked up a bit as per the price chart, but it eventually closed out with a loss. Entered and exited all these trades here. As the price chart was declining, it closed out with a loss. Now the average down process in this example, entered once here, entered once here, entered another lot there, entered another lot there. So we've entered 3 positions, 3 contracts at the moment. So we're averaging down. You can see here the price is moving up. Now, even though our initial entry was up here, our third position was entered down here, and we're actually, the profitability is reaching our break-even point there. So it's currently sitting at 3,598, and we've started back there at 3,647. Let me go back to another example where you can see where it closed out. This one here. You can see here the price started declining, and our stop loss strategy was also declining and losing money, with the exception of that little gain there. it opened a position there and it closed out with a nice little profit. Here we opened up one position on our average down strategy and opened up a second position and it closed out there. So overall, that's how the average down process works. So I suppose what I'm trying to say is the stop loss program overall is not as effective, although you need to have money management strategy playing a part of your average down approach. Let me quickly go through some other charts. That was the Australian 200. Let's look at the US 500. Now you can see here the US market, the price chart, is doing quite nicely, with the exception of the COVID period in March to 2020, and it started going up from there on. So overall, the stop loss process has been doing quite nicely. It leveled off and dropped your profitability there a bit, but started gaining momentum again and gaining profitability there. So overall, during this last probably 2.5 or 2 or 3.5 years, it generated $696 in profitability. The average down process has generated 3,021, so it's done quite nicely. And the drawdown is basically the highest point of profitability down to the lowest point of profitability. That's the drawdown. I'll go into the other example. Let's look at the FTSE. You can see this is more sort of level in terms of price action. Dropped off during COVID, had a bit of a curve there, and then a bit of a spike, a bit of a rise there as well, but it's been leveling off again. You can see their profitability for the stop loss examples versus the average down approach. So again, the drawdown has dropped there to about $4,000. So you need to have enough funds in your account to make sure you've got that covered. And a few more average downs happened here as well. But overall, we've generated 3,075 for the average down process versus we're in the negative for the stop loss example. Germany. So this is doing quite nicely, very similar to the ASX and the US market. A few little drops, but overall it's generated 1979 versus 13,085 for the average down process. Lastly, we'll look at China as an index. Again, being stopped out all along this period, very struggling to break even during those years. Finally broke even in that spike there, dropped off a bit, whereas the average down process had a few average downs and drawdowns there. We're currently in a drawdown on this one here as well. So I'll keep an eye on that. And lastly, gold. I'm just showing you basically all these charts because they've all got slightly different price actions. So in summary, as the price goes up, the stops also work, but overall the average down process works better. So what does that mean in terms of our summarize our results? So you can see here this is the stopping example for our respective indices. So over that period we generated just over $6,000 with a drawdown of $6,000 as well. So it's done about 100% returns on our drawdowns. The average down process, that's where we average down for whenever it reaches minus 5% drop and the CCI 100 breaks above zero. It's generated 30,000 in revenue, the drawdown of 21,000, so 141% return on a profit over drawdown. So that's what we're suggesting you probably should be using if you chose to do this. Now you might say, well, okay, we're comparing the average down, 5% drop and 10% gain. 5% drop, 10% gain for a stopping strategy. What I did as well, I ran another scenario where we said it drops 20% with only a 5% gain. So we're not asking for a bigger gain. We're asking for a 5% gain versus a 10% drop or a 10% gain. And that's what it looks like. So this is the average down process again with a 20% drop and a 5% gain. So we're minimizing our gain and maximizing our drop. So what that looks like, this is a stop program scenario. we generated $6,100 and a $6,000 drawdown and 102% gains. That's roughly on a monthly revenue at $35. The program 2 generated $30,000 with a $21,000 drawdown. That's 141% return. And program 3, which is a 5% gain as opposed to a 10% and a 20% drop. That actually gave us a bit less return, but also a less of a drawdown. So 173% percentage over drawdown, percent profit over drawdown result. So basically, in summary, the stop loss programs and examples can generate results, but it only works effectively when your price is going, if you're going long, if your price chart is doing that, you will generate some returns with your stop loss strategy. But if your price goes sideways, like in the FTSE example, sideways or downwards, you can see there the price declined there and you've lost your profitability there. Now, it did also go down as profitability with our average down, but eventually it always breaks above your profitability. So again, it takes longer to recover your losses using stop losses. Anyway, just want to throw that out there. I'm not saying stop losses are useless, but you've got to be very careful what strategy you use and how you apply it, and looking at all those various elements in your approach. Hope that's helped, and we'll speak to you guys in a future video.